Sea Limited dropped 20% in a single day. That's roughly $13 billion in market cap gone. And the weird part, they actually beat revenue estimates by 6%. So I put the earnings release and the investor deck and dug into the key numbers. Because when a stock drops 20% on a revenue beat, either the market knows something you don't, or it's overreacting to something it doesn't fully understand. I wanted to figure out which one is it, so here's what I found. Let's start with the headline numbers. Q4 revenue came in at $6.85 billion. Wall Street expected $6.45 billion. That's a clean beat, not a rounding error, genuine 6% surprise to the upside. For the full year, Sea did $22.9 billion in revenue. That's 36% growth year over year. And to put that in context, just 2 years ago, in fiscal 2023, Sea's revenue was basically flat, single-digit growth. The market had left it for dead. Now, it's growing faster than most tech companies in the world. All three business segments, Shopee, which is e-commerce, Garena, which is gaming, and SeaMoney, which is financial services, are now profitable. All three. That's never happened before at this company. Operating income tripled from $662 million to nearly $2 billion. Net income was $1.6 billion, up 260% year over year. So why did the stock crash? The answer is one number: earnings per share. Wall Street expected around 80 cents adjusted. Sea delivered 63 cents GAAP. That's a 21% miss on the bottom line. And the market punished it immediately. But here's what matters. Why did they miss? Because if it's a demand problem, if customers are leaving, if the business is shrinking, that's a real problem. But if it's a cost problem, if the company is choosing to spend more, that's a very different situation. So I dug into where the money went. Sales and marketing jumped 34% in Q4. That's the e-commerce competition showing up. TikTok Shop has been aggressively expanding across Southeast Asia. Lazada has Alibaba's backing, and JD.com just entered the region. Sea is fighting a ground war for market share, and they are spending to win it. Credit provisions, that's the money set aside for potential loan defaults in their financial services arm, surged 67% to $393 million in Q4 alone. Their loan book nearly doubled in size, so they are provisioning accordingly. The point is, management is deliberately choosing market share over margins right now. CEO Forrest Li basically said as much. 2026 will be a continuation of this approach. The market didn't like hearing that. Now, let me walk through each segment because the story gets a lot more interesting when you look under the hood. Shopee is the e-commerce business. It's 72% of Sea's total revenue. And underneath the headline spending, the core business metrics are genuinely strong. Gross merchandise value for the full year GMV which is the total transaction volume across the platform, hit $127.4 billion, up 27%. Core marketplace revenue, which is transaction fees and advertising, the high margin stuff, grew 50% in Q4. Ad revenue alone grew over 70%. Think about that. The high quality revenue inside Shopee is growing significantly faster than the overall business. The take rate, revenue as a percentage of GMV, expanded to 13.5% in Q4, up from 12.8% a year ago. That's more dollar captured per transaction. Active buyers are up 15%, purchase frequency up 10%. They now have over 400 million active buyers and 20 million sellers. Brazil, which was the big risk a couple of years ago, is now their fastest growing market and it's profitable. The concern is real though. Shopee's EBITDA margin on GMV is only 0.6%. That's thin. The competition requires continued investment, but the demand side of this business is not the problem. Next, we have Garena, which is the gaming arm. And honestly, this is the segment that surprised me the most. A year ago, Garena was the bear case for Sea. The narrative was that Free Fire, their flagship game, was declining and gaming would be a drag on the whole company. That narrative is dead. Full year bookings hit $2.95 billion, up 37%. Revenue grew 26%, with the gap explained by deferred revenue recognition, which is actually bullish. It means $541 million of future revenue is already in the bank, waiting to be recognized. Daily active users crossed 100 million, paying users grew 15%. The paying ratio ticked up to 9.2%. They launched EA's Sports FC Mobile, and it became the most downloaded mobile game in Vietnam. Free Fire World Series set a Guinness World Record with 600,000 competing players. The EBITDA margin on bookings is 56%. This is a cash machine. Garena alone generated $1.66 billion in adjusted EBITDA. That's nearly half of the company's total segment EBITDA, despite being only 10% of revenue. One thing to watch, Q4 bookings dipped 20% from Q3. Q3 had a Squid Game collaboration that was a one-time boost, so some normalization is expected. But it's worth watching whether bookings stabilize around $650 to $700 million per quarter. Finally, SeaMoney, which is the financial services arm, lending, payment, banking, and is the fastest growing segment at 60% revenue growth. The total loan portfolio, including both on-book and off-book loans, crossed $9 billion. They added over 20 million new first-time borrowers in the year. Active credit users grew 40% to 37 million. Average loan size is about $240, up 27%. And here's the critical number. The non-performing loan ratio, that's loan more than 90 days overdue, actually improved to 1.1%. The loan book doubled and credit quality got better, not worse. They are also expanding beyond Shopee. Off-platform loans lending to people who aren't buying things on Shopee grew over 300% and now make up more than 15% of the total lending portfolio. They have integrated with national QR payment systems across Southeast Asia. The risk here is credit cycle risk. At over $9 billion, this is a real loan book. A regional economic downturn could cause rapid deterioration, but right now the numbers are clean. Okay, so here's where it gets really interesting. Let me walk through the valuation, because the headline numbers are actually misleading in both directions. At $90 per share, Sea's market cap is about $57 billion. The headline PE ratio is 35.6 times trailing earnings. The headline free cash flow yield looks incredible, 12.7 times price to free cash flow with $4.5 billion in free cash flow. But there's a catch that most coverage I have seen doesn't mention. SeaMoney is a lending business. When your loan book doubles, the cash generated from operations gets reinvested into new loans. That cash isn't really free. It's working capital for a financial institution. So I ran the numbers both ways. If you strip out the loan book growth and the deposit funding that supports it, the adjusted free cash flow is closer to $1.8 billion. That puts the price to free cash flow ratio at about 31 times, a very different picture than 12.7 times. The truth is somewhere in between, and honestly, for a company with an embedded fintech arm, neither number alone tells the right story. The cleanest way to value C is sum of parts. You value each business separately using the right framework for each one. Start with Shopee and Garena, the operating businesses. Shopee did $881 million in adjusted EBITDA. Garena did $1.66 billion. Combined, that's about $2.54 billion. These are platform businesses with strong growth. So depending on whether you use a conservative 15 times EBITDA, a moderate 20 times, or an aggressive 25 times, you get a range of $38 billion to $63 billion for those two segments. SeaMoney is different. It's a lending business, so you value it on book value, not EBITDA. The on-balance sheet loan portfolio is about $8 billion net of credit allowances. Southeast Asian fintech lenders typically trade at 1.5 to 3 times book value. At 1.5 times, SeaMoney is worth about $12 billion. At 2 times, $16 billion. At 3 times, $24 billion. Then you add in the net cash. Sea has $10.6 billion in cash and short-term investments on the balance sheet, but not all of that is truly available. $3.8 billion is customer deposits funding SeaMoney's lending business. Another $3.1 billion is escrow, money held on behalf of Shopee buyers and sellers during transactions. And there's $1.8 billion in debt. So adjusted net cash is about $1.9 billion. Add it all up, in a bear case, conservative multiples across the board, the total enterprise value comes out about $52 billion, base case around $69 billion, bull case about $89 billion. C has about 638 million diluted shares outstanding, so that translates to roughly $81 per share in the bear case, $108 in the base case, and $140 in the bull case. At $90, the stock is sitting between the bear and the base case. The market is giving SeaMoney almost no credit and applying a compressed multiple to Shopee and Garena. That feels like the EPS miss is being over-extrapolated, but it's not irrational either, given the competitive uncertainty. So here's how I see this after going through the full filing. The EPS miss is real. The competitive spending is real. And management is telling you to expect more of the same in 2026. If you are looking for margin expansion this year, it's probably not happening. But this is a cost problem, not a demand problem. Revenue grew 36%, core marketplace revenue inside Shopee grew 50%. Garena went from a liability to a $1.66 billion EBITDA cash cow. SeaMoney doubled its loan book while improving credit quality. They paid off $1.5 billion in convertible notes. Even after netting out deposits, escrow, and debt, the balance sheet still has about $1.9 billion in adjusted net cash. The underlying business is meaningfully stronger than it was when the stock was at $199. The question, and it's a legitimate question, is whether C can convert this growth into margin expansion once the competitive environment stabilizes. That's the bet you are making if you buy here. You are betting that the spending is temporary and the revenue engine is durable. The things I will be watching: Q1 2026 margins. The full year EBITDA margin came in at 15%, but Q4 specifically dipped to 11.5% because of the spending ramp. Does it recover? SeaMoney's non-performing loan ratio currently 1.1%, but anything above 1.5% is a warning sign given how fast the loan book grew. And TikTok Shop market share data in Indonesia and Vietnam, that tells you whether the spending is actually working. If this kind of deep dive is useful to you, where we go through actual filings instead of just headlines, let me know in the comments. Subscribe and I'll see you in the next one.